Welcome to the National Pork Board's June Producer Webinar. My name is Courtney Knupp, and I oversee the International Market Development Strategy for the National Pork Board. Today's speakers will offer a domestic and global perspective to climatology, market volatility, current event implications, and the most recent Hogs and Pigs report. We appreciate their expertise to provide insight for nationwide pork producers and their business endeavors. This is our antitrust statement. All the work at the National Pork Board does comply with the Sherman Act. The best rule is if you have a question whether a certain matter can be discussed, clear it with an attorney. This is our National Pork Board disclaimer. Pork checkoff funds are being used to host this webinar with the purpose of helping pork producers understand publicly available information. The views expressed by the guest speakers are theirs and not those of the National Pork Board. I would now like to introduce our first speaker, Andrew Thut, to offer his insight in what producers can expect related to weather conditions throughout the summer. Take it away, Andrew.
All right, excellent. Thank you, Courtney. Just as a quick introduction about myself, I am a meteorologist. I got my career started in TV and spent about 5 years there before switching gears to work for a few different private weather providers. And while I was doing that, I was working as an operational meteorologist where I was actually making the forecast and then eventually transitioned more into a sales role. My current role is with IBM and the weather company. I am a sales engineer and meteorologist over there. And what I do is I assist different companies with their weather data needs. So there's a lot of different companies that will come to us with interest in taking our weather data and incorporating it into their decision-making or building out analytics or model. And so many of those customers do happen to be agribusinesses. So I'm thrilled to be part of the webinar today where I can kind of get back to my passion of actually getting involved in forecasting and diving into that a little bit further. So what we're going to do today is we can go ahead and advance to the next slide and talk about the agenda. I wanted to start off by talking about the growing season thus far. What have we seen for precipitation anomalies? What have we seen for temperature anomalies? What does the drought look like? And then we'll also focus in on the weather pattern itself and how that weather pattern has changed over the course of the last 8 weeks or so. And then we'll also bring that into what we think is going to happen with the pattern moving forward. And with that, we'll talk more about a monthly forecast and a seasonal forecast. And then finally, you can see the acronym on the screen for ENSO. We'll provide an ENSO update. What that is referring to is El Nino and La Nina and what we're experiencing there and how that's similar to what we're actually seeing in our current pattern. So with that, let's go ahead and dive in on the next slide. And I wanted to talk about precipitation ranks and really what we've seen since May 1st. So May 1st up until this week, we've seen extremely wet conditions noted by the green colors on the map in the Pacific Northwest, and that spilled over into the Dakotas and into Minnesota. We also saw some wetter conditions in portions of the Ohio Valley as well. And so a lot of that really came in from April into May. We had a pretty wet pattern in place where we had a trough in the Pacific Northwest, and some of that energy spilled into portions of the Northern Plains and into the upper Midwest. And that's why we saw some of those rainfall anomalies in some of those areas. Now, as we advance to the next slide, what we'll notice is that in June, the pattern has started to shift a little bit. So we continue to see those green shades up in the Pacific Northwest where it has continued to be really wet. But we've seen more of a ridge develop over the central portion of the nation. And what that's done is that's brought drier conditions into the eastern Dakotas, into Minnesota and Wisconsin, and some of those rainfall anomalies in the Ohio Valley, those also haven't been quite as pronounced. And so in the next slide, what we'll see is precipitation anomalies for the current month. All right, so what we're looking at here is the green areas. Those would represent areas that have seen above average precipitation, whereas the brown really representing a lot of the Corn Belt here. Those have been areas that have seen below average precip. So for the most part, areas where corn is grown, areas where soybean is grown, we've seen those conditions be near or below rainfall during the last month. Now, as we switch gears and talk about temperature as well, which we'll see on the next slide, we'll see that the cooler than normal temperatures indicated by blue on the map, that's really been present in the Pacific Northwest, spilling over somewhat into the high plains of the Dakotas and portions of northern Minnesota, where kind of that wetter pattern was in place, whereas the rest of the Corn Belt has generally seen near to above average temperatures. And since June 1st, on the next slide, you'll see that that continues to really be the issue. So near to above average temperatures for most of the Corn Belt, but some of those warmer temperatures, again, sneaking into Minnesota and portion of the eastern Dakotas as well. All right, so when we're talking about farming, soil moisture can obviously be of importance. And so this is something that I pulled from June 27th, and it shows the current calculated soil moisture anomalies. And so it's really no big surprise here that some of these areas that during the last couple of months haven't really seen a lot of precipitation or have seen those precipitation deficits and have seen near to above average temperatures, those also tend to be the places that have these soil moisture anomalies. So it's been very dry over Nebraska into portions of western Iowa. Meanwhile, as you get into the eastern Dakotas and northern portions of Minnesota, that's where it was really wet when we kind of pushed into those spring months, and they still are carrying some of that moisture within the soil as well. But for the most part, you know, when we look at that Corn Belt area, soil moisture anomalies are certainly at a deficit as well. All right, so let's talk about the drought. And so what we are looking at here is not the current drought monitor, but we're going back in time and we're looking at the drought kind of more when the growing season started to kick off right around May 3rd. And what we can see here is that for the most part, most of the Corn Belt avoided drought conditions with the exception of when you get into portions of Nebraska, eastern South Dakota, western Iowa. Those are areas that on May 3rd did have a drought. So if we fast forward to the next slide and we look at the current drought, for the most part, we haven't seen a ton change. Actually, there has been some improvement in portions of Nebraska in regard to that drought. But what we have seen is a slight drought develop in portions of Indiana and also portions of Illinois. Some of that drought is also kind of present as we kind of push into the mid-Mississippi Valley and down into the lower Mississippi Valley as well. And so what we'll talk about moving forward is what we expect in terms of drought conditions as we roll through the rest of the summer. But on the next slide, what we will see is what it would actually take to get out of those drought conditions, to kind of get back to that normal stage or that climate normal. And so as we look through, say, portions of Nebraska, western Iowa, Illinois, Indiana, you can see some orange boxes on this map. And what that's telling us, and this is kind of divided by climate districts, what that's telling us is those areas in kind of that true orange, they're basically at a 3 to 6 inch rain deficit. So that's how much rain would be required to pull them completely out of those dry conditions and get back to those normal conditions as well. Based on what you'll see in the forecast moving forward, I'm not quite sure that those areas are really going to achieve that, as my confidence is a little bit higher that if there was a part of the Corn Belt that would continue to see the dry conditions, it would most likely be those conditions, that those areas that have that orange on the map as of right now. All right, so let's talk a little bit about the current weather pattern. You'll see this on the next slide. And I'll try not to geek out too much with my weather terminology here. And so what we're looking at is geopotential heights. And this is a reanalysis of looking at the weather pattern since May 1st. So almost disregard geopotential heights and think of that as saying weather pattern. And so what we're seeing on the map is the areas in the blue and the purple, that would represent a trough in the atmosphere. When we talk about a trough, that tends to align with a low pressure system. Okay, so the low pressure system, that's going to bring in the precipitation. So we're seeing that low, we're seeing that trough associated with the Pacific Northwest, just kind of situated off the coast. Meanwhile, there's been a ridge in the eastern United States, and that jives pretty well with what we've seen. Where there's a ridge, that tends to mean high pressure, and high pressure, generally speaking, will give you drier weather. That's what we saw for the most part in the eastern United States. Now, it's also worth noting that trough that we saw in the Pacific Northwest, that kind of spilled off over to North Dakota, South Dakota, portions of Minnesota as well. And so what we saw is energy from those storm systems in the Pacific Northwest. It kind of rode a storm track and went through the northern plains, went into northern Minnesota. And that's why, in April and May, that's why we saw wet conditions in those areas. Now, we have seen a change in that weather pattern as we look forward to what's happened during the last month. So on the next slide, this is going to show us that weather pattern since June 1st. So you can see some similarities. You still have that blue purple area off the Pacific Northwest. It's actually shifted a little bit further to the west. Remember, when we talk about a trough, that's in line with a low pressure system. Meanwhile, we've seen a ridge develop in the central portion of the nation. Again, that ridge, that would coincide with an area of high pressure. So it's really no surprise that we've seen some of those slight drought conditions start to build into places like Illinois, in Indiana, and portions of the mid and lower Mississippi Valley, because that's what the weather pattern is telling us. Now, it's also really unique that you see some of those blue shades in central Canada, and that spills over into New England as well. So that's the presence of kind of a weak little trough or a storm track there. And so when we talk about what's expected moving forward, I would not be surprised if that storm track could potentially shift maybe a little bit further south. So leading back into the Dakotas, in Minnesota, Wisconsin, the UP, portions of Michigan, potentially down into the Ohio Valley. So we'll talk about that more in a second, but probably getting a little bit ahead of myself. On the next slide, if you want to advance to that, we'll talk about a precipitation outlook. So this outlook, it was issued by the CPC. The CPC is the Climate Prediction Center. And what the Climate Prediction Center is thinking is that pattern that we've had in place for much of June, where we've started to see that ridge develop in the central portion of the country, they think that's going to continue during the month of July. And that's what's going to bring those dry conditions to the midsection of the country. As we advance to the next slide, for the most part, we'll see that that same type of pattern is expected to really continue for July, August, and September. However, they're expecting that that ridge could potentially shift a little bit further to the west. So that's how things are looking in terms of precipitation. Let's now advance over toward temperature and talk a little bit more about that. And so with the monthly temperature outlook, remember they have that ridge in the central portion of the nation. That's also going to bring portions of that part of the country above average temperatures as well. So it's not necessarily smack dab right in the middle of the Corn Belt. We're seeing it a little bit further off to the west and to the south. Now, to note, as you get into the northern plains, the Dakotas, Minnesota, Wisconsin, that's where it's seen as equal chances. The CPC is looking at that and they're saying, man, it could be warmer than normal, but I also see a situation where it could be a little bit cooler than normal. And so I think really what it's going to come down to is what happens to that trough that was in central Canada, eastern Canada, into New England. If that drifts a little bit further to the south, I think some of those northern areas in the Corn Belt could start to get into maybe slightly cooler temperatures or more normal temperatures. And I think those are probably going to be the areas that have the best threat for seeing higher amounts of rainfall as well. But as we pass forward to the seasonal temperature outlook, for the most part, you're going to see the same type of thing. Okay. So in this case, they're actually thinking that if anything, that ridge is going to be a little bit more pronounced, and the drier signatures that we've seen as of late are only going to bolster and get stronger as well. All right. So that covers precip, that covers temperature. Let's talk a little bit about the drought outlook, and we'll see that on the next slide. All right, so what we're seeing here is if you think back to that drought monitor slide, the drought was absolutely crazy in portions of the Western United States, and that's where we're seeing the brown. That's where there is a drought in place today. But as we look forward, what areas are most likely to see drought-like conditions over the course of the next few months? And it's really right in line with the areas that are starting to see that drought develop. So we talked about Illinois seeing a slight drought. We talked about Western Indiana We talked about the mid-Mississippi Valley potentially seeing that drought. And with that ridge in place, again, I think that this is pretty much spot on, that these are the areas that would be most likely to be under the gun for a drought. Now, also thinking about Nebraska, portions of Western Iowa that kind of have that drought in place today. Again, with that ridge in place, I think there's a pretty strong chance that that drought's going to persist. And again, I think the best chance for more precip is going to be in the northern portion of that corn belt. So some of those areas in the eastern Dakotas that grow corn or soybeans, or portions of southern Minnesota and southern Wisconsin, I think those are the areas that are most likely under the gun to see more of the wetter and cooler conditions, and that could potentially build into the Ohio Valley. It's the southern portions of the corn belt that I think are really going to be under the gun for the driest scenario or the warmest scenario. All right, so with that, let's transition to the next slide. And by the way, I also did want to mention that in line with the CPC, I've been looking at some other computer models, and one of those models comes from the European, so the ECMWF. And so they make a long-range computer model, and it jived really well for the most part with what the CPC did have to say. It did note that some of those areas in the Dakotas, in northern Minnesota and the UP, again, when we talk about northern Minnesota and the UP, not necessarily ideal places for crops to be grown. But again, if any place did see those wetter conditions, I think that those would be the places that would see that. And probably the best scenario for that happening is going to be during the month of July, as storms kind of ride around that high pressure system or ride around that ridge and plummet into those areas. All right, so let's get back to talking a little bit about ENSO. Okay, so ENSO is, a fancy way of talking about El Nino or La Nina. So what we've been is, as we look at this black line, and you can see it's been below this minus 0.5 down to -1. What that means is the equatorial Pacific sea surface temperatures, they've been below average, and it means that we're in a La Nina. Now, during the last couple of months or so, we've slowly been climbing out of that kind of extreme La Nina to a more conservative La Nina. And there's even some evidence that we could continue to climb out of that over the next couple of months. But then as we get into fall, it seems pretty locked in that La Nina is going to be the most likely scenario. And then finally by winter, maybe that's a situation where we shift out of La Nina into more neutral conditions. But on the next slide, what we'll see is, what does La Nina really mean? And so what I did is I looked back in time and I said, let's look at some past summers where there was a La Nina present. And when you take all those summers, you can see the years at the top, 1955, 56, 71, 74, etc. When you take all those years and piece them together, what are the precipitation anomalies? And so typically what we see during La Nina summers, this is the precipitation pattern. We see drier conditions over much of the Corn Belt. So similar to what we're kind of expecting for the rest of the summer. Again, that's a little bit tempered though, because I wouldn't be surprised if, some of those northern areas did start eventually to get a little bit wetter. But overall, this is the pattern that we tend to see with La Ninas. And on the next slide, we'll talk about what it tends to mean in terms of temperature as well. So La Ninas actually generally bring cooler than average weather. But what we're seeing here is that if there are areas that, have more seasonal temperatures, it tends to be smack dab right in the middle of the nation, right where that ridge is going to develop. So, I don't think that most of the country is necessarily going to see below average temperatures, for the rest of the summer. That's common with La Nina signatures. But again, this is just kind of what we've seen in the past. And then finally, on the next slide, we'll talk a little bit about the drought index. And so again, this is looking back at La Nina years. What are the areas that are most likely to see a drought? So when we think about our current drought, talk about Nebraska, we talk about Western Iowa. I mean, that is right in line with kind of the signature type of weather that we typically see with La Nina years. So with that, I went a little bit fast. We'll probably get a little bit of time back. So I want to thank you for giving me the opportunity to present. And with that, I will pass it over to our next speaker in line, who is Erin. Erin, go ahead and take it away.
All right, great. Thanks, Andrew. And I suppose I will show how we don't have room in the global balance sheet for any weather issues. And it's a lot to tackle, and I love our industry, so bear with me as I try not to cram in too many details here. And Nate, let's go ahead and start. And we don't need to read through all of these, but to try to frame up the situation, these are some of what I see as the big factors out there for the global pork market, and especially as we think in the context of the Ukraine situation. And so essentially, the world seems to get more and more complicated. And at the same time, there are some opportunities, I think, for pork and for US pork specifically. So we'll talk through that. But one thing to start out is a lot of the price trends and the trends generally were underway before the invasion of Ukraine. And that just accelerated the inflationary situation. And of course, of critical importance is oil and gas and feed and fertilizer. And so we'll focus in mostly on the feed factors. And with that, I think the production efficiencies of the US are of critical importance. And so our low cost production advantage as we look globally is perhaps as important as ever. And when we think about the global pork structure, our biggest producers outside the US and again, in the world would be China and then Europe when we add them all together, the European countries. And we have declining production in Europe for really potentially the first time in recent memory. Production was record large last year. So that's a big changing dynamic. And the war in Ukraine certainly doesn't help them. So we'll touch on that. And China's production, I'm not going to say dropping, I'm going to say maybe stabilizing. And there's lots of things evolving in that market, which we're going to spend some time on. And otherwise, there are all of these other dynamics, which are of critical importance, and we'll kind of touch on, including things like currencies as we work into the end. But when I think about this, given the high cost environment and the fact that it doesn't seem like these, we'll just call it input costs, are going to decrease in the near term, in my mind, exports are just more important than ever to ensure that we maximize the value of every animal we produce. And also when we think about the impacts of inflation and geopolitics and everything else that's happening, COVID still being in play, we need to have customers around the world and remember that these markets or customers are all impacted differently. And so we need to have access to all of them to make sure that we're able to find, the highest bidder and competing bidders for our products. And so again, those soaring input costs for farmers specifically, I'm just calling out Wall Street Journal article on February 15th and ahead of the invasion. So again, these factors were already in play, and it just kind of threw fuel on the fire when Putin invaded Ukraine. Okay, on the next slide, we'll talk through some of those really important dynamics as far as our pork world. So Ukraine was number 4 exporter of grains and oilseeds, number 6 exporter of poultry, and top exporter of sunflower seed oil. Then we have Russia as a top supplier of wheat, fertilizer, oil, and gas. And when we look at this, for the most part, Russia's exports have been largely unaffected. They're able to export more oil to China and India, and fertilizer still flowing to Brazil. And again, for Russia, some of this has just been kind of a shifting of supplies rather than a real decrease in exports of commodities, where the situation is completely different for Ukraine. And we'll talk through that a bit more. I added some of the fertilizer details from the Fertilizer Institute, and I can't really do these justice, but one thing to point out is that for fertilizer, we hear a lot about the constraints because of the importance of Russia and Belarus and their supplying to the world. And a reminder that 90% of fertilizer use is outside of the US, and the US is a top producer. But also just to note that Brazil seems to have been getting its supplies from Russia, which was a big concern because of Brazil's reliance on fertilizer for its crop production. And then on the next slide, we'll start to get into some of the grain details. And when we look at the markets that Russia and Ukraine are shipping to, in this I'm lumping all of the cereal grain crops, all the oil seeds, and then fats, which is so important these days because of the sunflower seed oil dominance really of Russia and Ukraine in that part of the market, and also because of the renewable diesel demand here in this country. So the strong demand for soy oil and really all fats and vegetable oils. So knowing that whole market was already in a tight supply situation, when we figure limits on Ukraine's exports, that's really important for things like fat in our livestock diets. So I didn't have time to separate all these out, but lumping all of that trade together, you can see how big the volumes were out of Russia, 56 million tons, Ukraine, 65 million tons. That's a calendar year last year. And then when we look at the top markets, especially for Ukraine, their top markets are of real importance to the pork world. So Europe was 22% of Ukraine exports. China was 21% of Ukraine exports. And for Russia, Europe was 10% of their exports and China was 5% of their exports. So we're going to spend most of our time on Ukraine. And in the next slide, we'll talk a little bit about some of the challenges for Ukraine's exports. And you can see here that the Russian occupation is spreading along that coastline. And of course, everyone is concerned about Odessa. I've heard others say that Odessa is kind of the equivalent of New Orleans for Ukraine's exports. And at the same time, we know their seabound exports have really been handicapped since the invasion for various reasons, including mines in the Black Sea, including the inability to get insurance and infrastructure damage, all sorts of constraints. And so there are also many efforts underway to try to assist in exports across land. Different rail gauges between Ukraine and Europe are one of many headaches. And they've been able to export, say, 1 million tons a month rather than, 5 to 10 million tons a month. So the real focus is on needing to move grain out of storage that is still sitting in storage because Ukraine is expected to produce crops this year. And these are the Ukrainian ag estimates. And these came from a Kansas State presentation last week. And so wheat production, 18 million tons expected for this year, corn 25.7, barley 5.2, and then sunflowers 10.6 million tons. So you can see that these numbers are down from the 2021 volume, but still significant. And then their current estimates for grain storage capacity were 44 million tons. So again, knowing there are millions of tons still in storage and that these crops are in the ground and there's going to need to be storage freed up for these crops as they're harvested this fall. Okay, Nate, in the next slide, we're going to talk a little bit more about the corn situation. We hear a lot about the wheat side, which is, of course, of critical importance for human food and nutrition. And on the feed side, to me, at least, the corn situation is of critical importance and probably the area, along with those fats, having the most impact on feed costs and livestock rations around the world. And so these are USDA's June WASDE estimates. And you can see that the new crop is expected to be for the world down just 2% from last year. And Ukraine specifically, USDA's estimate is about 25 million tons, down from 42 million tons in the prior year. And during 2020, 2021, Ukraine's production was 30 million tons. And that year was the COVID impact. So they had some limited inputs applied to that crop and kind of similar constraints as they're seeing today, obviously not as bad as they're seeing today, but that's sort of the contrast. And so again, production expected to be down 41% for Ukraine specifically. And if we go to the next slide, we can see that on the export side, it's a sharper decrease. So USDA expecting exports at just 9 million tons. And that compares to 23 million tons, which may or may not fully get exported for the current crop. So when I add up the exports based on Ukrainian shipments, I get October through April shipments of about 20 million tons. So getting close to that USDA estimate. But they should have exported most of what they produced last year. So still below export potential if they had been able to ship this product out. And in the next slide, we'll take a look at the import situation. And we know that China has been the big driver here. And so globally, imports peaked in 2020-21 with China's increase in demand. And as a side note, that was also the year that the phase 1 agreement was implemented. And US and Ukraine are the suppliers of corn to China. And so you also will have heard that, let's see, I think it was last month, so kind of late May, China had announced that they were working on protocol to import Brazilian corn. And this makes sense because in the export expectations, you see that Brazil is where the growth is projected, and Brazil is expected to partially offset and potentially completely offset that decrease in Ukrainian corn exports. So again, China looking to finally import corn out of Brazil to help add another supplier in the mix, because so far, if we look at Chinese import data from September through May, they imported about 18.3 million tons, of which US was 65%, Ukraine was a third. And China did import heavily out of Ukraine earlier this year, even at strong prices, and so helped pull some of that product ahead. And of course, again, they need another supplier of corn, and we're watching for that Brazilian product to flow in their direction. And also just a note here, China's been importing more sorghum, and those imports reached about 6 million tons, again, in the September through May period, of which 60% were from the US. And sorghum, it has a benefit over corn in China because it doesn't have the TRQ related restrictions. And so it's easier for those importers to handle sorghum. And again, the US is the big supplier of that product. And here, while we're still on the importing slide, you note that Europe is a big importer of corn, and for their data posted through April, so September through April imports were about 10.5 million tons, and Ukraine was 60% of that volume. And their imports from Ukraine, EU imports of corn from Ukraine, dropped in March and April. So even for the, the land-bound shipments, those volumes really plummeted after the invasion. Okay, let's go on to the next slide and look at essentially the corn stuck in Ukraine. So Ukraine exports most of their corn that they produce. And so we should not see 6.77 million tons expected to be ending inventories of old crop. And you can see USDA, even though they increased their production estimate for Ukraine in the June WASDE, but they left exports at 9 million tons. So you can see the bigger 12 million ton carryout expected for the new crop, which again shows the constraints on Ukraine being able to ship corn out. And in the chart, I'm showing you the ending stocks, but backing out the China numbers and also backing out Ukraine. And you can see that those ending stocks are expected to remain pretty tight, especially if we run those on a stocks to use, where clearly high prices have rationed demand to some extent, but you're looking at a really limited availability, especially a product that can actually flow for the world market. And that's what's keeping these prices elevated. All right, in the next slide, just for another way of looking at this, China's importance in the global imported grain, oilseeds, fats market, and also Europe being an important net importer. And also to flag on this slide that I should have calculated up the estimates for Egypt and Vietnam. And when I look at those, I get about 30 million tons and 28 million tons going to Vietnam and Egypt. So just behind Japan, they're also top importers. And in that case, this is including both food and feed, because wheat is in these numbers as well. And that's why you're hearing so much about concerns for unrest in Middle East and Africa, as these lower income consumers have a hard time sourcing those more affordable grain products. And then again, we also know that the big importing markets for US pork are also big importers of grain. So when we think about the cost of production, they're paying that high world price for grain plus the high shipping cost. And so that means that US still has the production advantage for pork specifically. All right, in the next slide, the US is the biggest pork exporter in the world. When we take Europe and break it apart, so we're the biggest exporter ahead of Spain, Canada, Brazil, Denmark, Netherlands, and Germany. And we are also the top exporter of grains and oilseeds. And so again, I see this as a real advantage for the United States, and our grain and oilseed foundation is critical and should set us up to be a supplier of the future. So if we look to the next slide, you can see the growth in pork production for these top exporters, and growth in exports has been quite strong. I've taken 2021 and looked back at the change since 2015, so after PED, or after that big outbreak especially in North America, but really in many of our markets in 2014. And again, you see the growth and across the board in production and exports. Also, a bigger share of production being exported for all of us top exporters, and a bigger share of those exports going to China. Note that our competitors, especially Brazil and Europe, are much more reliant on China than we are. And then we also share in common most of these top markets. Brazil is the exception here because they have limited market access due to foot and mouth disease. But so when we look at the next slide, the US is not the low priced supplier. We know we're low cost, but we're not low priced. And I see that as a positive. Our really strong domestic demand has helped keep our hog and pork prices strong. And we've paired that with really robust exports. And that's the way it's supposed to work. But we've also been up against cheaper European product and cheaper Brazilian product as the China demand went away. And so we've seen US prices above European hog prices since early 2021. And that's been a constraint in our markets around the world, which we'll touch a little bit more on. But in the next slide, China is kind of a big story this week and last week. Their hog prices are rising, and they correlate really well with China's imports or pork exports to China. And you can see that we have been forecasting an increase in shipments to China late this year. And now in the next slide, you can see that China's hog prices have been increasing. They've actually jumped further. This week, they climbed to 19.3 yuan per kilo yesterday, and that's about $1.30 US. And it's the highest since May 2021, and up about 60% now from the low in March. And we think that flooding in southern China is a big part of this. And also state purchases for reserves, which have totaled close to 400,000 tons so far this year, although those purchases haven't actually happened. It's been psychological. And there's a real bullish sentiment in the market. Our staff caution that this has been kind of a psychological situation, and also the flooding is a real big impact, and that consumer demand is still sluggish. So if we move to the next slide, there's been kind of mixed optimism this week. So with China's announcement that they're cutting the quarantine period for international travelers from 14 to 7 days, that got the markets excited for a minute. There's also actually a 3-day self-isolation period, but that's down from 7 days. So it's really 10 days quarantine. And then at the same time, the COVID-0 impact is still significant because of China's restrictions on cold chain product. And so still testing, disinfecting, and tracing imported frozen pork, for example. And this has really limited China's demand, even for our variety meats. That's my 2-minute warning. And so to see China really come back to life, some of this COVID policy, including the impacts on the economy, have to shift. We also have to remember that we have the 25% tariff disadvantage on US pork and variety meats into China due to those metal tariffs, of which the administration has been not talking about eliminating. They've been talking about Section 301. So we still have that disadvantage. And Nate, on the next slide, we'll look at the growth in Europe's exports to basically all of our markets, markets other than China. And so this is the cheaper European product that we've been up against since China really slowed down mid last year. And so even if US pork is still at a disadvantage in China, if China can start buying more out of Europe and Brazil, that's going to support all of us as far as prices. And in the next slide, we'll just skim over it quickly, but variety meats to China remain critical for US pork. They are our biggest customer for things like feet and stomachs and heads and tongues, and they add tremendous value to every pig we produce. And we see that demand still there. It's just the COVID zero constraints and added costs that have limited our shipments to China of these items. All right, in the next slide, we'll wrap up quick on one of the biggest changes. I think that this was already underway prior to Ukraine, but Europe's pork production now looks like it could decline. Friends of mine, analysts in Europe, say it could be down 3 to 5% this year. I talked to Neil Dirks' German friends at Pork Expo, and I was heartbroken for the German situation. Their inventories in May were down 10%, and they've been in sharp decline, but the growth in Spain had kind of been offsetting the decreases in Germany, and that is no longer the case. So this slide just shows the European Commission forecast, which only has production down slightly this year. So it would look even more stark if I had the analyst expectations in the chart. But then importantly, I think the Commission is forecasting a decrease over the outlook period. And we contrast that with the growth expected in the US, expected to return to growth. And this is what we make sure we tell to the international customers, that we will be the supplier, of the future. I just want to wrap up here on the room for consumption growth. This is kind of complicated, but I think it's important because I have the hot pink there, as you can hopefully see. That was 2020, and there was some inventory build ahead of COVID, which was ASF related. But otherwise, the combination of ASF and COVID had a big impact, more so ASF. And we had seen this strong trend growth in consumption and a return to that growth. And this is where the opportunity is in the international markets for US pork to continue to really allow this growth in pork consumption around the world. And that is what underpins our forecasts. And we have essentially forecast that US pork exports have bottomed out. We'll see year-on-year growth in the back half of the year, which should put us down somewhere around 5% from the strong level last year, still running at 25-26% of production. Mexico taking 9 to 10% of our production, as they have since August of last year, and helping to offset that slowdown in China demand. But then China helping to come back in next year and expecting that 6% rebound in US pork exports and through the diverse growth across our markets. So with that, thank you so much. And I'm going to turn it over to Altin Kalo, Chief Economist with Steiner.
Thanks, Erin. Well, good afternoon. My goal today is to go over the results of the Hogs and Pigs report that came out this afternoon, touch on some of the highlights, and more so what the implications of the report are for supplies and prices as we look down the road. Next slide. So, before we always look at the numbers, we also look at what USDA did with their previous estimates. More so, we have some idea as to what kind of changes they made based on the supplies that came through. And before I go through the report, I think it's just one thing that I always like to mention when I'm in these kinds of presentations. There's always a lot of griping about USDA data. Does it match up with the reality? Are we seeing the sort of numbers that they imply? Are they off, 0.5%? Are they off 0.25%? They missed it by a few thousand head. In the end, 4 times a year, we have a report that covers the whole nation. There's no entity out there that is able to do this. They're able to get survey results from around the country. They have established a track record. They publish what their error rate is for everybody that wants to go and look at it. And in the end, it's sort of the baseline that we all use. And then we measure against that baseline. We can always argue about forecasts and projections, but it's really hard, if not impossible, to do that if you don't have a baseline. And that's what USDA provides to us. Looking at some of the adjustments that they made, they revised the market hog inventory, that they reported of March 1 by about 410,000 head, or 0.6%. They did 2 revisions to the pig crop from the previous quarters, obviously to reflect the slaughter that came to market in the spring and so far. They revised the pig crop for September, November by 411,000 head, or about 1.2%. They always attribute this to farrowings, although you never know whether it's farrowings, whether it's the number of pigs per litter. But when you look at their statistics, it's usually the farrowings that reflect this change in the pig crop. And then they also revised the December-February pig crop by about 123,000 head. And that's also one of those forecasts that as more data comes through, they may end up revising it again when they do the next update. Let's look at the next slide. So, key numbers in the report. We mentioned the total inventory down about 0.9% from a year ago. It's not very different from what the analysts were expecting. The breeding herd is down 0.8%, slightly higher than what the analysts expected coming into the report. And the number of market hogs, down 0.9%. Again, not very far. If you look down the line, I mean, most of the numbers came very close to what the analysts were expecting coming into the report. We always kind of look at what the analysts' expectations are as a proxy for what sort of is built into the market, right? So, the thinking is that the futures are certainly pricing some of these expectations. And if the number comes too far out of the range, then maybe we expect some sort of an adjustment when the markets open up tomorrow. Based on this, I would say that this is a neutral report for the market. But let's look at what the implications are for supplies and pricing down the road. The first category would be market hogs and what the implication is for supplies in the next 5 to 6 months. USDA breaks the inventory of market hogs in 4 different buckets. And that's helpful because depending on what bucket, what the supply in each one of those buckets is, we can sort of pinpoint what the supply, what sort of supply we should expect, during that time period. If you can go to the next slide, I guess that probably helps explain it a little bit better. So this is what weekly slaughter looks like, right? So we've been, we have a seasonal component in hog slaughter. Usually slaughter is higher in the fall and in the winter, and it tends to decline in the spring and the summer. That's been, playing out again this year. It happened just pretty much every year. The only year where things were different was in 2020, where the closure of some of the processing plants caused hogs to get backed up, and then they had to be processed in June, July, and August when usually supplies are light. So we're sort of following the seasonal trend at this point in time. When we look at those market hog baskets, what they imply is a weekly slaughter that through early to mid-July is about 0.8% lower than a year ago. Obviously, we've already seen a fair amount of these hogs already come to market. When we look at weekly slaughter up to this point, it's been running a little bit ahead of what the USDA estimate is. So the expectation is that we may see a little bit more hogs come to market in the next 2-3 weeks. Then for the next period, which would be sometime mid-July through mid to late August, that's hogs that are between 120 to 179 pounds, according, in that USDA breakdown. The expectation here, again, based on the survey, is that we should see supplies run a little bit less on, than 1% from a year ago. When you look at the supply that came to market during that, period of time, it was a little bit under 2.4 million hogs. So you can calculate that we're probably, according to the survey at least, we're probably going to be around 15,000 head less than the weekly kill that we saw last year. And then for September, early October, again, USDA expects, not USDA, I guess the survey would imply supplies during that period to be about 0.6% lower than they were a year ago. One number that was slightly different from what the analysts were expecting was the supply of hogs coming to market, during October, mid-October to late November, and these would be hogs that are under 50 pounds at this point in time. The USDA survey says that supply of hogs is about 1.3% lower than it was last year. Last year, we saw weekly slaughter during that time period hit about 2.6 million head per week. According to this, we're probably going to be about 35,000 head below that on a weekly basis. But again, those are rough numbers. In any given weeks, they're other factors at play. You can have plants that may be down, they're running maintenance, other kinds of disruptions, but at least this sets sort of a baseline as to what the supply estimates are for the rest of the summer and then going into the fall. Let's look at the next slide. And so one number I always like to, I think it's probably one of the better numbers that the USDA has in the survey is the breeding herd. We can always argue about the number of market hogs, were they counted correctly, are they placed in the right buckets, all of that. But one number that I think all producers know pretty well is how many sows they have, right? So that's one of, and so it's a good number because it's pretty robust, but it's also a pretty good number because it gives you a good indication what to expect going forward. Between December 1st, 2019 and March 1st, 2022, we saw the breeding herd drop almost 7%. Some of that was just the fact that the margins started to erode. We've been increasing the breeding herd for quite some time, and then COVID hit and caused a lot of pain in the industry that may have forced some further reductions, and then we started to see higher feed cost prices. So all of those combined to really put a lot of pressure on the breeding herd. And at this point, we're at the lowest level we've been in about 5 years. This latest survey put the breeding herd at 6.168 million head. That's 1.1% lower than it was a year ago, but it's about 70,000 head higher than it was in March. So does that mean that the industry has kind of found a bottom here and we're about to trend higher? Not necessarily. If you look at we've had some previous year, 2012, 2013, where going into summer, we had an uptick in the breeding herd, and then those high feed costs come into play and the margins start to erode. And then you see that breeding herd start to pull back again. But at least at this point, that's what the USDA survey is saying, is that now we have a few more sows out there than we had 3 months ago. Let's look at the next slide. So as we talk about the breeding herd and what could have contributed to it increasing quarter to quarter, there's a few inputs that go into it. One is, how many of the sows that you already had, were culled during that quarter? Did we see an increase or a decrease in imports? And what the gilt retention was during the quarter. One number we don't know is gilt retention. There's no data out there from the USDA that tells us that number. And the only way that maybe we can get to it is kind of to back into it by looking at the entire balance sheet. And the balance sheet would be, what's the breeding herd that you're starting with? How many did you slaughter? What did you bring in, mostly from Canada? Actually, all of it from Canada. And then, what's the ending inventory that USDA reports now in this survey, right? So you have all these, and the only item then that you're left that you don't know is the gilt retention number. And so you can kind of back into that number when you know all the other pieces. And so this chart, that's kind of how it was constructed. And I've done it for March, May, starting in 2010 to current. And this is year over year change in that implied gilt retention number. Last year, that implied gilt retention number was about 5% lower than the previous year. According to this latest data, we actually retained a few more gilts than we did last year, 2.5%. It's not a big number, but it's a little bit of an increase. So, what could have driven this increase, even though we've got all these high feed costs? Well, part of it is we've been liquidating for quite some time. The other part of it is that February through May, the producer actually was in the black, even though we had some higher feed costs. Looking at that Iowa State model that kind of projects, fair to finish returns, the average return was during that period was around $25 a head, which is pretty good. And so that may have also contributed to it. The other part of it also is that we've kind of delayed this Proposition 12, and now it's gone to the Supreme Court. I suspect that some of the reason for the pullback in the breeding herd numbers, especially in the second half of last year, had to do with that Proposition 12 coming into play. One easy way, well, I don't know about easy, but one way in which you can increase the square footage per sow is by reducing the number of sows you have. It's not an easy decision, but if somebody pays you enough to do that, maybe some producers are out there, doing it, especially the vertically integrated ones. So with that decision now being postponed, and the possibility that it actually may not go into effect, I don't know, I'm not a lawyer, that may have also encouraged a little bit. So that's sort of where we stand with the breeding herd. If we can go to the next slide. One thing that USDA does also is that it asks producers, what do you expect the farrowings, how many births you're going to have through a certain quarter. And then you use that number, you put in some sort of a factor for pigs per litter, maybe you put a trend, maybe you look at the recent quarters, and that gives you some idea what to expect for the pig crop for June, August. The June-August pig crop is going to tell you what at least is going to give you an indication what the supply is expected for December, February. And so one thing that kind of stood out here is that when I look at the farrowing intentions that was reported, and then compare that with the breeding herd on June 1, that ratio is at 48.9. Last year was a little bit higher, but last year seemed to be a little bit of an aberration as well. All the previous 7 years, the ratio has been over 50. So are we going to go back to the previous ratio, or what happened last year is probably more of what we expect? Was last year also a function of labor challenges and COVID and disruptions that producers had to endure, and maybe some of those disruptions have receded a little bit? We don't know, but to me it seems that farrowing intention, at least from a historical perspective, is a little bit on the low side, and we may actually have a few more farrowings than what the USDA survey suggested. That implies that the production numbers down the road, especially for the December, February quarter, may not be down as much as what the USDA would suggest. And then the next piece. So we have, the next slide on the pigs per litter. So there's two ways, that the producers at least can improve the productivity, where even though you may keep the breeding herd steady or increase it a little bit, you can also add to production by A, farrowing a little bit better, and B, by actually getting more pigs per litter. You look at the last 30 years, we've been on an upward trend in the number of pigs saved per litter. It hasn't been a linear trend. For 10 years, we've had the number of pigs per litter increase at a pretty steady pace. You slow down a little bit because some of those gains that you have because of genetics and so forth, you start losing, and then you get another jolt. Maybe you get some new genetics in place, and you improve your management and so forth. So what's happened the last couple of years is that the number of pigs saved per litter has flattened out. COVID was a big part of it. Disease pressures, PRS, other diseases have been part of it. And so that's taken away from some of the supply that's come to market. Are we going to go back to that growth trend? Again, if we're able to manage the farrowings a little bit better than we did last year, and if we've got a little bit more pigs per litter, then the expectation would be for to get a little bit more supply, especially in the December, February period. And then the last slide that I have, this would be just the pig crop expectations. The pig crop for for the second quarter, which would be the March-May period, was down 1% compared to a year ago. According to, if I were to take the farrowing numbers that USDA published and apply to it a pigs per litter that reflects kind of what recent history has been, we would expect the June-August farrowings to be down 1.2%. I'm sorry, the June-August pig crop to be down 1.2%. But like I mentioned earlier, I think the odds are, or the risk is that pig crop number may not be down as much as what USDA suggests. And then for September, November, which would be the number of hogs coming to market next spring, the expectation is for supplies to be close to what they were this year. And with that, I think I'm out of time, and I'll just stop there.
Well, a big thank you to our speakers today, Andrew, Erin, and Altin. You guys had great insights A couple comments from the National Pork Board, especially to our producers. We know that global events, the economy, the weather, and more, they're all challenges that we have no choice sometimes but to reactive to versus proactive, and that all impact the environment, economic, and social sustainability of farms and pork production. The good news is that we can be proactive about tracking and measuring the practices on your farms now that you are in your control, and these practices align with the questions domestic and international consumers are asking us. Personally, as a leader in the international market development team at the National Pork Board, I have the honor to tell our international customers about U.S. pork's commitment to continuous improvement and to establish U.S. pork as the global leader in sustainable agriculture. We need producers to participate in the checkoff funded on-farm sustainability reports, which this slide speaks to the progress that we're making. And this is something that you as a producer can control today. On-farm sustainability reports help measure and document producers' continuous improvement efforts. National aggregate data from the report can be shared with customers and key decision makers to demonstrate U.S. pork producers' commitment to sustainability. The blinded aggregate data will be used at the state and national level to share real data on producers' commitment to sustainability, allowing the pork industry to continue to build trust in modern pig farming while protecting pig farmers' freedom to operate. From an international perspective, this will be an excellent way to demonstrate and show data to support our sustainability story, which will definitely differentiate U.S. pork versus pork of other origins.